In this video, the latest in our short series on trading strategies, I thought we'd take a look at the idea of trading breakouts. Hello, I'm David Jones from Capital.com, and I thought in this video we'd have a look, short video on the subject of trading breakouts. These can be powerful because they can signal the start of the next major move in the market, regardless of the time frame you're trading. But we can't just jump in the direction of the break. I think we need to give some thought to where our stops go in terms of managing risk and that sort of thing. So before we talk about that, let's just take a quick look at what I mean by breakouts. So we'll take a look at some really good examples from the short term from the DAX, the German index, and also some longer term examples on the pound US dollar. So for our breakout example, let's take a look at the DAX, so the German index. So we're looking here at an hourly chart, and you can see September the 10th trades up to 12,040, sells off, moves up again September the 12th, 12,040, and again later on the same day hits 12,040. So that is clearly the level that we need to watch for any potential breakout. Let's just move forwards in time. So here's the break. So this is an hourly chart. So the market pushes through that level. It jumped really quickly, jumped about 40 points, 35, 40 points on the level. So one way of trading this is we have an order in above waiting to buy, or we watch the breakout and see what happens next. So really, if we get a pullback, it can be an opportunity to buy in. But breakouts suggest there has been a change in sentiment. So about 7 hours later, the market does pull back. So this can be the opportunity. If we missed out on the break and we think the market is going to move higher, this can still be an opportunity to get in on what we think could be the next move higher. And as it turned out, the market did push higher following the break. So if we move forward again, you can see following the break, we've got another level that's proving to be a problem, around about 12,130. Trades up to it 13th September, up to it again the next day, the 14th, and later that same day up to it again. So again, there's a couple of ways to trade in this. We can put an order in to buy just above 12,130, or we wait to see what happens if the level breaks. Let's jump forwards again. So again, we get the move. It breaks. If we had an order in to buy, we'd have been in the trade. Otherwise, we can wait for the pullback, wait for the strength to come back, place a stop loss, maybe the other side of these lows here, and wait to see if the market moves higher from there. But even though this has been pretty volatile on the breaks, it does show that if we have a definite level that proves to be a problem, if we get a move through it, it can be a suggestion that maybe the market is starting some new trend. And just to wrap this up, you can see on that last break, it did actually start a move that went on for about 200 points. Okay, so it's not necessary to jump in as soon as the level breaks, but it can be a suggestion that things are changing. The same applies, of course, to breaks to the downside. Just to illustrate the principle the other way around, this is pound US dollar. This is a 4-hour chart. So we've gone back a little bit to the lows from March, around at 137. The market rallies all the way up to 144. So we saw a 700-point move off that level. It comes back down again. We're expecting the level to hold, old support, but it breaks, and it broke here, and it did follow through. We got the odd rally to sell into, but you can see all of these support levels that get formed on the way down. When it breaks, it can be a suggestion that the next move lower is starting. So once again, you don't necessarily have to get on right as soon as the level breaks, either up or down. But when we see a move, we want to think about trading in the direction of that move. So if we get, in this example here, where it breaks through old support and squeezes back up, then fails, that can be our opportunity to sell short. So hopefully those examples make it clear. What we're looking at is a market that maybe keeps hitting highs, doesn't get through, and then suddenly, bang, we get the break. And the flip side is a market keeps bouncing off support, but then in the time frame we're watching, breaks through the support. An aggressive strategy is to jump on the move straight away, but I think that can give something of a problem when it comes to setting stop losses, because maybe you don't know where your stop loss needs to go. Perhaps the more disciplined, more patient approach is to wait for the market to push through on the breakout, then come back and then resume in the direction of the break. That way you can have a tighter stop, and it's maybe a more managed, more disciplined way of trading. Of course, it does mean if a market really starts running away, you're going to miss out if you're just trading off the breakout. But I think there are enough times, as we saw with those DAX examples, where the market will break, come back and retest, and then move away. It's a really simple strategy. It doesn't work all the time, which is why we need sensible risk management such as stop losses, but it's a great way of identifying the potential for a new trend starting and getting in pretty near the beginning of that move and having a sensible place the other side of the breakout for placing your stop loss. We'll start wrapping things up there for this short session on trading strategies. As usual, if you have any questions or a different view, just leave us a message in the comments down below. When it comes to our YouTube channel, we put up lots of content. We look at different markets, popular currency pairs, cryptocurrencies, stock market indices, trading strategy videos like this. So to never miss out, if you make sure you're subscribed by clicking subscribe, not surprisingly, and then click on the alarm bell notification, you get notified every time a new video gets uploaded. But for this introduction, we'll leave it there. So from me, David Jones and Capital.com, good luck with your trading.